Hello, this is Japanese Economic Review Channel. Today, we'll analyze the April 2026 machinery orders data released by the Cabinet Office. As a vital leading indicator for capital expenditure, this report offers profound insights into Japan's economic position. Let's explore what these figures tell us about domestic corporate confidence. Total machinery orders reached 4.03 trillion yen, up 3.4% from March. The highlight is the core private demand, surging 8.7% to 1.09 trillion yen. This robust domestic investment appetite is successfully offsetting the 8.6% drop in external demand caused by global headwinds. Why focus on machinery orders? Because large-scale industrial machinery takes months to build and deliver. Today's orders enter a manufacturing backlog. Therefore, this data acts as a highly reliable crystal ball, forecasting actual corporate capital expenditure, CapEx, trends 2 to 3 quarters in the future. To see the true domestic signal, we filter the 4.03 trillion yen total by removing volatile elements like external demand, government spending, and the ships and electric power sectors. What remains is core private demand, the truest measure of underlying domestic corporate confidence, which grew 8.7%. We are seeing a clear divergence. Total private domestic demand surged by 5.8%, reflecting broad-based corporate investment. Conversely, external demand contracted by 8.6%, dragged down by ships and general industrial machinery. Japan's domestic engine is currently shielding the economy from this slowdown. Looking deeper into the 8.7% core private demand growth, we see broad-based confidence. Both manufacturing, which grew 5.1%, and non-manufacturing sectors, which grew 6.7%, posted synchronized, strong month-over-month expansions. This proves a widespread commitment to capital investment. In manufacturing, tech is accelerating. Information and communication machinery soared 47.1%, and business machinery jumped 50.3%, driving the index upward. This tech boom is overpowering cyclical contractions in traditional heavy industries like steel at -41.9% and chemicals at -36.7%. For non-manufacturing, physical expansion is the theme. Real estate saw a massive 107.7% surge, while transport and postal grew 36.9%. These figures, alongside construction's 14.0% growth, indicate a robust corporate belief in continued physical movement of goods and infrastructure development. This matrix visualizes the investment momentum. Growth is heavily concentrated in tech-enabled manufacturing, logistics, and physical infrastructure. Meanwhile, traditional heavy industrial materials like mining, which dropped 45.3%, are cooling off. Capital is clearly flowing towards digitalization. External demand fell 8.6% to 2.23 trillion yen. While this looks sharp, it follows a massive 31.0% surge in March. The contraction was mainly in overseas orders for ships and industrial machinery. Notably, global demand for Japanese electronics and communication machinery remains a resilient countertrend. Looking at the production pipeline, there is a structural bottleneck. The volume of incoming machinery orders continues to outpace factory output and realized sales. This dynamic is rapidly inflating the total order backlog, ensuring factories will stay busy for the foreseeable future. The total backlog is climbing toward 50 trillion yen. Crucially, the months on hand metric sits at a solid 15.0 months. This means Japanese machinery manufacturers have immense revenue visibility. Even if new orders halted today, factories have well over a year of work already queued. In conclusion, Japan's domestic engine shows remarkable resilience, driven by an 8.7% surge in core private demand. Capital is heavily pivoting towards tech and infrastructure. With a massive 15-month order backlog guaranteeing future CapEx realizations, Japan has enough structural momentum to weather global headwinds. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.